In this video, we will talk about finding undervalued gems in an all-time high market. This is what is happening right now. The market is screaming higher. You have a lot of things happening at the same time. And the US stock market, the S&P 500, just reached an all-time high territory. So what kind of stocks can you buy in this market? Do you have to buy specific stocks? Do you have to sell specific stocks? This is what we are going to talk about. And we will do so reacting to this video from Adam Khoo, finding undervalued gems in an all-time high market. So what I will do is I will put the subtitles on and I will comment. I will make some pauses on this video and I think you will learn a lot of things about the global picture of this market. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year doing stock picking. So only picking the great stocks, the best stocks I have in my portfolio. And Adam Khoo is a great inspiration, great YouTuber. Please subscribe to him if you have not done so yet. And let's start. So I will start the video. Normally you should hear well, and I will make some stops, some breaks to add some comments, okay?
So US markets are at all-time highs again, and every time this happens, the media will scream that the markets are too expensive, it's a bubble, there's nothing to buy, it's gonna crash, get off the markets. But as you guys know, if you've been in the markets for as long as I have, you realize that every single year, no matter where the market is, whether the market's at all-time high, all-time low, in the middle, there are always great investment opportunities. There are always great companies selling at discounts. And that's what we want to accumulate as value investors. So the question is, are there undervalued gems in this all-time high market? Well, let's find out in this video. So investors who keep saying that the market is too expensive is because they're looking at specific metrics like the price to earnings ratio, which they say is too high compared to historical averages. And that is true. It is high compared to history. If you look at the forward PE ratio of the S&P 500, is at 22.1 times earnings, which is above the 5-year.
This chart starts in 2015, okay, at a forward PE ratio of 15-16. And ends now. I'm recording this video September 1st, 2025. So just so you know. Okay, fair enough. If you look at the PE ratio for the S&P 500, well, Adam is sharing the forward PE ratio. Here is the normal PE ratio, if you don't take into account the growth. If you look at the past 10 years, so same data. In the past, the PE ratio for the S&P 500 in 2015 was 21, 22. Now it's at 29. So you had multiple expansion over the years. And this is exactly what you can see here, even with the forward PE ratio. So just so you know, normal PE ratio 30. Forward PE ratio should be at 22, 23. Okay? The forward 12 months PE ratio is 22 right now, above the 5-year average, above the 10-year average, above all the averages you can find. So yes, if you only look at the numbers, this market is a little bit expensive, okay? But because of the growth rate of the earnings, that should be warranted. We'll see.
Mean of 19.9 times and above the 10-year mean of 18.4 times. But you've heard me say this many, many times, that PE ratio by itself is meaningless until you compare it with the earnings growth rate.
Yes.
That, you can't compare the PE of the market today than 20 years ago, because companies today are growing a lot faster than they did 20 years ago.
Yep. Same thing for people that look at the S&P 500 for the past 100 years and compare this metric in the past to now. I mean, now you have much better companies right now. Now you have companies that are thriving and big behemoth. For example, Amazon is not an e-commerce company. It's an everything company. So we didn't have this in the past, where one company invested so much in multiple industries that is now operating like as a country, I would say. If you look at the Amazon Prime customers, that's in the hundreds of millions of people, it would be as big as a country, actually. So, and they are buying things from Amazon on a very regular basis. Same thing for Facebook, Meta platforms, right? You have 3 billion users. It would be the equivalent of a continent. This is the first time in history we have such powerful companies. So, can you really compare the P ratio of right now to the P ratio you got in the 60s? The quality of companies are better now. The efficiency is better now. Everything is faster now. Earnings growth is faster now. So maybe this is warranted. Well, I'm not saying a PE ratio of 30 is deserved, but maybe a little bit higher than what we had in the past, right? By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
Today have much higher profit margins. In fact, double to triple the profit margins today than they had, 20 to 30 years ago. The other thing that you must also look at is this. Yes, if you look at the overall market, it looks expensive. But within the market, if you look below the hood, you have some companies that are way overpriced. They're really in a bubble. But there are also companies which are fairly priced and some companies that are underpriced. It's like saying that all Singaporeans are rich or all Americans are rich simply because there's a high GDP per capita number. But that's not true. Within the country, you've got rich Americans, rich Singaporeans, you've got poor Singaporeans, poor Americans, you've got those in the middle. So same thing in the markets. Instead of taking a general macro top-down approach, great investors, they take a bottom-up approach where they look at individual companies and they see which are ones that are really expensive. There are those that are fairly priced and those that are underpriced. And that's where we can find undervalued gems in this market. So if you take a look at the S&P 500 right now,
yeah, this is exactly right. And later in this video, Adam will show you a table with a lot of stocks that are undervalued right now. So you clicked on this video to know more about the global market, but you will have a bonus. You will have specific picks. A good hunting ground for you watching this video, things that Adam considers undervalued, widely undervalued. Okay, so we will see.
This is the valuation of the 500 companies. So I got my research team, this guy Richard, who is heading the team to screen this out. So if you look at the 500 companies right now, you can see that about 160 of them are very expensive. So yeah, there are some which are really in a bubble. And these make up 31.9% of the S&P 500. I wouldn't touch these right now until they get cheap again. So highly overvalued means that they're selling over 20% above their intrinsic value. And then you got 13% of them, or 65 stocks, that are overvalued, selling above 10% to 20% above intrinsic value. So these are the ones that we want to put on our watch list. Some of them are great companies. We wait for the next big drop. When they get fairly priced or underpriced, we pick them up. But right now, we don't want to buy those, okay? Now, those that are fairly valued, we can look closer because they are near their intrinsic value between plus minus 10%. And there are 157 stocks within that range. So that makes up about 31% of the entire index, right? But then you've got 46 stocks that are undervalued, which means they are selling 10 to 20% below their intrinsic value. And you do have 73 stocks that are more than 20% below their intrinsic value. So this is where I find undervalued gems. And that makes up right now about 23.8% of the index. So what are some of these stocks? Well, let me share with you in this video. These are the stock tickers.
This is it. Let me put full screen so you can take a screenshot of this. Let me remove the subtitles. Please make a screenshot now if you want. If not, you can go back to this video 5 seconds before. You have plenty of stocks that are here. That's the S&P component, so you should have 500 stocks here. And you have all these stocks that are undervalued here at the left and all the stocks that are overvalued at the right. I mean, the overvalued category is large. You have plenty of names and maybe you hold some of them. For example, you have Exxon here. Great company. Actually, it's such a great company. We analyzed Exxon inside my coaching program. We analyzed together to see the strength of the company. It's a beautiful company, but at such a high valuation, maybe you don't want to buy right now. It's overvalued. The facts are here. This is an overvalued company. The potential is immense. The company is growing largely, but overvalued. So maybe you don't want to buy at current levels. And at the other side of the spectrum, you have things that are widely undervalued. This is by order of the name, alphabetical orders. You have Lululemon, for example, here. Nobody wants to touch Lululemon. Lululemon is in a current drawdown that is, I would say, a multi-year drawdown. Look at the stock chart. The same price, it's 200. Same price it had in October 2019. So 5 years, 6 years of nothing. So yes, and since then, the company has improved their operations. It's just the P/E ratio that was so high at the time, and now that is quite low. So yeah, I agree with him. I don't know how they calculate their intrinsic value model. It should be some algorithm or somebody from the research department on Piranha Profits that is doing manually the work for all of them. But I think this is a pretty accurate list. So please copy this list and only focus on this undervalued, fairly valued category. This is a good hunting ground. I think this video from Adam is great. It adds a lot of value for us investors, for you investors, because it gives you all the stocks you need to watch. You don't need to open YouTube, Twitter, Substacks. You have a hunting ground that is here waiting for you. So if you just analyze everything on this list, you just focus on companies that are inside your circle of competence, that are cheap. You buy them and you can fill your portfolio with great companies here. So yeah, I think it's a great hunting ground. Please analyze these companies. And now I want to show you a post from Adam again that will give you more information about the seasonality of the market. 3 hours ago, he shared, fasten your seal bets. We are heading into September, the seasonally most bearish months of the year. Great news for value investors who have been patiently waiting for high quality stocks to drop back down below intrinsic value and support levels. It's true, if you look at this chart, September, October are famous for being bad months on average. Also great for new option seller like myself when price drops, etc. Well, this is if you are trading options. No guarantees that would happen, but one must always be prepared to take advantage. If you look at this chart, you can see that the first months are a little bit choppy. In April, everything rebounds. During summer, in July, everything rebounds again. And then September is a very volatile month. October is a very volatile month. And actually, after this, if you manage to hold your companies, November and December are known to be good months for the market. So now we just entered September. Be ready. We can expect more volatility in this market. As we started this video, we said the markets just reached an all-time high territory. Maybe we are due for a correction, and nobody knows if we will have a correction now, next week, next month. Nobody knows. So just be ready. Don't act crazy. This is the only thing you have to do, right? Be prepared. Own some defensive names if you want. Hold some cash if you want, or be invested 100%. It depends on you actually. But on average, depending on the seasonality here, September, October, we are going to see some volatility. We will see. We will see what will happen. But normally, we can expect some drawdowns in specific stocks. In the market in overall, but also for specific stocks. So yeah, I think now, as we enter September, you have some time to analyze companies that are undervalued. And maybe your time will come. And let's say in 1 month we have a correction. You will have done the work and you will be prepared in case the market drops. Investing is all about preparation, right? You want to invest in companies that you have studied for a while, you want to prepare because anything can happen. If there is a market crash, if there is a market drawdown, and you come prepared, this is heaven. This is lovely. You will have done the work. You are confident in your strategy. You know the company very well. You know the stock very well. You know how it works. You can buy at a discount. This is how I generated 25% per year. I did not generate 25% per year for almost a decade, buying with FOMO, fear of missing out. Not at all. It's all about preparation. And on this channel, I cover specific stocks that I'm not buying because they are too expensive in my opinion, but I'm studying them again and again and again and analyze businesses and businesses and businesses. So when we have a market crash, I'm here and I can buy heavily. So yeah, good lessons from Adam. Thank you, Adam, for sharing this with us. I think this is pretty good for all the retail investors. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a video, a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.